listen-only mode.
Welcome to the webinar, Balancing Act, Managing Risk and Rewards Post Silicon Valley Bank. We have an esteemed group of panelists, gentlemen. Well, I don't want to say gentlemen all, I will just say gentlemen. Let you sort it out. John Winick, CEO, Clark Capital. John, you're the moderator. Thanks for joining us. Josh Siegel, CEO, StoneCastle. Umrai, Managing Director, Performance of Trust Capital Partners, LLC. Jim McAlpin, sorry, Jim, I butchered that. Jim McAlpin, partner, Bryan, Leighton, Paisner. Gentlemen, thank you all. Please ask your questions during the presentation. You can do it one of two ways. We prefer the chat. That way John Winick can see it. And you can just put it in the chat box if you're in that's cumbersome, you're in a conference room or something, you can do that. Shoot it over to Mike and he will bring it up. I think you all know the GoToWebinar dashboard. By the way, this is also being live streamed on YouTube at YouTube Coma Report. If you have a fire drill and you are called away, it will be up there for you to view at your leisure. And with that, John, this is the 5th webinar on this series I believe you've done.
Yes, they've all been great opportunities to talk about the latest what's going on in the bank industry.
For those I'm going to just real quick. For those of you who don't know, this is really, really a quality panel of these are the experts. So I'm going to stop talking, John, and let you go. Go ahead.
Thanks, Bob. Well, we're going to start with the president by Gill at Performance Trust. Take it away, Umrai.
Appreciate everybody being with us today. What you see in front of you is an article that we published in April 20 of 2023. This was right after SVB. This was right after the big liquidity problems that happened in March. And what was surprising about that time was Q1 earnings had just come out, and the industry actually posted was what at the time record margins and record earnings. And some people were wondering, like, how are you publishing something that says there's a significant earnings problem coming, but it's hidden in plain sight? Where if you look at the fine print, we talked about how upwards of 1,000 U.S. banks, 1 year out after the industry had just come off a record quarter, could actually start becoming unprofitable. Now you're wondering, like, how could that be so early? If you go to the next slide, John. What we saw at that time was a relationship that we understood was happening, but really as an industry, we're not really thinking forward in terms of what it would really mean. So fundamentally, banks over the course of 2020, 21, and 22, if you rewind the movie, were deluged with deposits and also getting cash back from their existing asset books. And so we're forced at a time to reallocate a tremendous percentage of their capital. And what happened was during the course of 22, as rates rose with funding costs lagging, the industry experienced 2 or 3 quarters of record profitability. But the problem at the time was, if you actually were able to look into the future, that many of our risk management frameworks didn't capture the fact that when the Fed funds rate increased 500 plus basis points, that their funding advantages would start to migrate toward historical norms. Meaning this wonderful increase in rates that was creating record earnings was going to be fleeting and ultimately create compressing margins. If you go to the next slide, John. So where do we come up with 1,000 banks? Next slide. If you look at what's going on with the funding position of the industry, I'll wait for it. Essentially what's going on is, if you think about the Fed funds rate as gravity is to matter, the industry's funding mix has been changing. So 2 years ago, the industry was funding itself with record amounts of non-maturity deposits stuck at 0. 10% of our industry's funding mix was effectively wholesale. if you look at a short period of time, 3 or 4 quarters, from Q2 of 2022 to Q2 of 2023, the wholesale positions in the industry on the grid to the right increased by double. So 10% of our funding mix was wholesale. So think borrowings and CDs. That moved to 20% of our industry now being funded wholesale, and it's only going up. So if you go to the next slide, John, what that's doing is creating significant pressure, this remixing, alongside of remixing into higher interest rates on funding advantages that banks enjoyed in 2022 and the first part of 23. So if you look at historically back to 2007, why 2007? Well, the Fed funds rate was right around where it is today. And our industry is moving back toward the funding mix the industry had at that time, which was significantly higher levels of borrowings and CDs as a percentage of funding. And so at that time, you could see that the best deposit base funded itself at a 223 cost of funds. That would be the 90th percentile deposit base. So higher percentile is lower cost of funds, higher is better in terms of percentile. The bottom percentile institutions funded themselves north of 4% at that time, and the median funded itself at 3.25%, which was a funding advantage, the difference between the Fed funds rate and where the bank funded itself of 200 basis points. Now, if you take a 200 basis point funding advantage and apply it to today's Fed funds rate, where does that leave us in terms of where the median bank is likely funding itself? 550 less 200, 350. So we think the median institution will start migrating toward a cost of funds somewhere in the mid 3s if the Fed stays in the mid 5s on the Fed funds target rate. So lastly, if you go to the next slide, we did a projection, and this came from our client insights and analytics group, where we looked at a sample set of about 3,600 banks, so banks above 125 million in assets, and we projected forward from publicly available data what it would mean for the institution's profitability, understanding their asset side repricing schedule, to try and approximate what pre-tax, pre-provision net revenue would look like if their funding advantage went back to the median in 2007. Here's what we found. We found that if we look at Q4 of 22, which is the top left, there was a lot of green bars, right? Green means more profitability. Red means effectively losing money. Q2 of 2023, John, if you click through it, you'll see the red bars have gone up, the green bars start to move down. Q3 of 2023, you're starting to see that migration away from green into light green, more blue, more yellow, more red. And then if you look out into Q2 of 2024, you're going to see that slightly north of 1,200 banks, we expect to have a pre-tax, pre-provision ROA of below 25 basis points. Again, why? Fed funds at 5.5%, median funding advantage likely to migrate to 200 basis points. A lot of remixing going on out of non-maturities, non-interest bearing into CDs, higher rate products, deposits leaving the system. And if that occurs, we expect north of 1,000 banks to actually move out of profitability. So, John, back to you. That was a lot, but it's a big thing in our view.
Sure. Josh, thoughts on what Umrai had to say?
Well, I would say it tends to follow historical norms, right? I mean, that's always the first test. You know, are you finding an outlier? Or is it grounded in history? And it is grounded in history. High interest rates, low interest rates, banks find a way to normalize. They pass it through to the industry, the borrowers and the depositors. It's the transition periods that are the hardest to absorb. And there was this false indication in the Q1 numbers because it is such a lagging indicator, right? That's the sort of famous negative gap in interest rates between the asset book and the deposit book. And that's what is catching up. And with all of the talk of higher for longer, or still maybe a few hikes, I think directionally, this is not surprising. It's disappointing, but it's not surprising.
Jim, any thoughts?
Yeah. So what concerns me, if we all think back to March, April of this year, when you had a couple of high-profile bank failures, suddenly the average person became very focused on the health of banks. And, my wife was asking me to explain deposit insurance to her. So what concerns me is if Umrai's firm is right, say 12 months from now, 1,000 banks have almost negative earnings. And the headline in the Wall Street Journal is bank profitability severely under pressure. Then a lot of banks start getting calls again about their health. And so I think this is an issue beyond just this 1,000, 1,200 banks. What concerns me is an industry issue where, once again, people are concerned about the health of their bank. And I think we've weathered the storm so far this year. I'm also concerned that despite y'all putting out that white paper, this is not an issue that's generally perceived to be emerging. And it's going to be one of these things that feels sudden, right? It's going to feel sudden. And so that it's general concern, John. I really do. I was amazed, the weekend after Silicon Valley Bank failed, I think I spoke to more bank CEOs over that weekend than I had, in the 4 months of this year prior to that occurring, which was basically, hey, what are you seeing? What's happening? I'm calling all my major customers. And I'd hate to see an event like that happen again, but I think we may be headed toward it, unfortunately. It's a perception issue.
Umrai, your analysis does not take into account whether banks are hedging their interest rate risk. I mean, are they? What sort of are you hearing?
Yeah, that's a great question, John. I'm going to connect my answer to that back to Jim's final comment, which is, or one of the final comments, which was, you mentioned it's going to feel really, really sudden. And I think there's a lot of truth in what Jim said, because what's happening is bank management teams know in their guts, and they see it month to month what's going on. They see the deposit flows. They see the cost of funds pressure. I don't think that's new information to a lot of management teams. What I think is really foggy for them is, are they able to actually look out far enough and have a framework to be able to understand what they're going to look like 9 months from now, 12 months from now? I think they're playing against a defense that, they're looking out 1 month, or what's our cost of funds going to be 2 months from now. But when you look out 12 months and you use the right framework, you're going to get answers that might be different than when you're looking at what perhaps happened last month. So, John, to your point, you are seeing management teams who do have the right framework. And I use that term a lot today, because basically what I'm saying is reorienting yourself during a time of change requires the recasting your future. And you have to recast it in a way you're not used to, by projecting cost of funds in a way that you haven't done before. And those teams that are doing that are being opportunistic with hedging strategies, not just hedging in terms of the use of derivatives, but also it informs, how much they're supposed to be growing. What types of capital allocation decisions should they be making? Should they be growing loans at what rate? So it's informing a lot of strategy, John, not just hedging. But I would say for those that are really confident in what they should be doing, it's probably 20% of the industry.
And John, just real quick, in terms of industry, one of the great things about the banking industry is, in times of crisis, there are great opportunities. So for those banks that are performing really well, on the flip side of this, there could be some great opportunities next year.
Yeah. Well, Jim, I know you work with a lot of bank boards. I know you serve on a couple bank boards. What kind of conversations are going on in boardrooms right now?
It depends on the bank. It depends on the board. I think Umrai is right. For a lot of bank boards, their perspective on how well the bank is doing is directly correlated to what they're hearing from management. I'd like to say that most bank boards read the monthly package and read call reports and are asking really incisive questions of management, but that doesn't always happen. So, a lot of it is, if the CEO seems concerned, the board's concerned. I think the Umrai's question, I think this is the kind of thing where, you think about it, what Josh said, it was a great first quarter, right? And then the 2 quarters since then haven't been great. So you kind of think, well, maybe if I stop making as many loans, if I really work on, cutting back on fixed rate loans, maybe this won't be bad. What concerns me a little bit is for a lot of these banks, let's say it's 1,000 banks, I'm not sure they can do that much between now and next year to really stave off this problem.
John, there's another side to that, sort of following up on Jim's comment. A lot of management teams and boards are driving down the highway, trying to adjust based upon the trend they see. For some banks, you don't see in the call reports what the benefit of any hedging that they've done would be, right? It gets blended into the profit and loss, but you don't effectively see the offset. I have unfortunately seen too many banks that hedge late. Oh, we should have been hedging. Let's hedge now. And then if things go the other way, there's actually more carnage on the way down. So that's something we also don't know whether it's happening or not.
Yeah. Well, there's been increased chatter on M&A. I had a conversation with an investment banker last week, and actually 2, and both of them said they're seeing an uptick. Obviously, M&A is the solution for some of these challenges, but it does seem like the issue with the unrealized losses makes M&A almost impossible in most cases. What do you guys think about the outlook for M&A, given that earnings and mark-to-market issue with the securities portfolio?
I can go first. I mean, there's 2 kinds of M&A. There's M&A that is proactive, and there's M&A that is reactive. So for the banks that are under pressure, that have an older management team and board, don't have a lot of prospects, they don't have much of a choice. And that's why it's not very much in the public eye, because the majority of banks in the country are privately owned, so you don't see it. But there's been a flurry of M&A among small banks. And I think we're going to continue to see that, not because they're being opportunistic on the buy or sell side. They just don't have another choice. They don't have the energy to go through this again. They'd rather just take the chips off the table, which ultimately builds strength by combining 2 smaller banks that are less efficient. You do likely make a bank that's slightly more efficient and stronger, but I think the pace will continue for the reactive. I think the proactive will slow.
Hey, John,
what concerns me a little bit, that's a lot, is let's say suddenly you have to do a deal. The AOCI issue has not gone away, right? I mean, so you're still, if you're selling your bank, you're going to make less money for your shareholders, because this is not a good time for a lot of banks to sell, given the securities portfolio. So I think Josh is right. I think there is an uptake, definitely an uptick in conversation. I haven't yet really seen an uptake in deals. I mean, right now we're bumping along at what, Josh, the lowest M&A deal level in the banking industry in a number of years, right?
Yeah.
20 years ago.
Yeah, Jim, it's marks can be cost for the seller, are a cost in their minds, right? But it's a real economic loss, right? So I think there's a transition period of mindset going into the mode of acceptance that there's some real economic loss that the bank has incurred, because either you hold those securities for the duration of their lives and you recover the OCI, but the problem there is a lot of those securities are at book yields that are below marginal cost of funding and where the cost of funds are going. So whether you want to hold it and experience a loss through the income statement, or hold it and punt the bank and experience loss up front, those are economic equivalents. So I think once we get to the point where the earnings, the AOCI mark, which is basically low capital trapped at low yields, turns into this graph that you see in front of you, the real earnings problem. I think that'll be a motivator. Now, the challenge is going to be for buyers. OCI and securities portfolio marks are fairly knowable. A 30-year residential portfolio, in terms of what it's worth, is fairly knowable. The big thing for buyers is going to be, how do I also project forward the cost of funds of this institution? What are they actually going to make? So I think that'll be a little bit of a hurdle for the floodgates to open that people have been talking about as well.
Yeah. Well, it does seem like it's going to be difficult to make the numbers work for some time. Josh, we talked about this a couple of weeks ago. There was all this fanfare for expanding deposit insurance. The FDIC put out their proposal, I think, early in July, and it's been crickets since. Anything happening with deposit insurance that you see?
I'll still take the under. I think it was a reactive view. I mean, obviously, a lot of folks in Washington were blindsided by what happened in Q1. And so there was immediate pressure for the FDIC to analyze the problem. But I think we're probably at a point, unless something else dramatically changes the landscape, I think that'll likely fade without any major changes, especially given the state of Congress and what's going on. Again, anything that's going to change does require approval from the congressional level down. I just don't see that happening.
Hey, John, do you put up this disclaimer every time Josh talks, or is that? Can I have one of those? Yeah.
Umrai's one.
I shouldn't take business advice from a lawyer. Can I have that disclaimer?
You gotta love the compliance folks.
Sorry about that, gentlemen.
We have a poll question. This is related. This is for bankers only. In the last quarter, has your institution added deposits significantly, added deposits modestly, little to no change, lost deposits modestly, lost deposits significantly? So basically, modest subtractions overall. This seems pretty consistent. The year-over-year decline in deposits in the last quarterly bank profile was the first annual decline in deposits ever. Of course, the data only goes back to '94, but the industry is seeing some loss of deposits. Any surprise in the poll questions, guys? Are we out of the woods on the deposit outflows at banks?
I don't think so.
I'd go back to Jim's point. I mean, if we start seeing more public commentary about bank profitability, that could be at risk again.
Yeah, John, I would answer that in a single word, and the answer is no. There's too much economic forces, so that wasn't a single word. Too many economic forces at play, and the funding advantage is going to continue to erode. And this. I mean, do any of us still have significant balances in our 0% interest-bearing checking accounts?
How many of us?
I have a few relatives that do. So one thing I heard this morning, I was sharing before this, I was at a Atlanta Chamber of Commerce meeting this morning, and the president of the Atlanta Fed, Raphael Bostic, who is a very, very bright guy, and he's on the Open Market Committee, he was asked about monetary policy, and they have great phrases at the Fed. He said, we are now in, quote, restrictive territory, and with regard to interest rates, and things are getting back in balance, and I think we should stay there for a while. So I think there was this hope for a while, hey, there's gonna be a spike, and then it'll start to go down again. I mean, based on those comments, which I assume reflect the views of a number of his colleagues, interest rates are going to stay at least where they are for a while, probably a period of, it could be years, at least many, many months. So that, I do think the more that sets in, and that the other thing is that people, I think, were really focused on deposit insurance in the spring of this year. And now, the larger your balance of deposits in a bank, maybe you're getting a little less concerned about putting in a Morgan Stanley account than you would have been previously, even though it's not insured. So that's going to be a challenge.
What's interesting is how universal the decline in deposits were when you looked at the largest banks. Having said that, while everybody lost deposits, keep in mind that the very largest banks have done the least to increase yield. So the funding advantage has increased for the largest banks, despite losing similar levels of deposits.
Yeah, there's still that other leverage on that doesn't get talked about as much, right? Yes, there's rates, but there are still the other, what would you call them, benefits that are being offered by the Fed, such as the reverse repo facility, right? So the reason deposits flee is because there is low friction for large depositors to either buy treasuries or money market mutual funds, right? Those are other options. But those rates offered by the short-term treasuries and money market mutual funds are also abnormally high because you still have gargantuan sums of money market mutual funds depositing at the Fed, earning a very high overnight rate. If that program were turned off, and those money market mutual funds still have to put that cash to work, they're going to have to buy treasuries. If they buy more short-term treasuries, rates on the short-term treasuries will decline, right? Because the price will go up for the short-term treasuries. And then that becomes less attractive, and then they come back to banks. So the Fed does have a second lever to pull in the engine room. I'm shocked that they're not doing anything, curtailing it, closing it, something to drive the funding back to the bank.
Yeah. Great points. Well, let's walk over to credit. Give you kind of a quick overview on credit. I mean, just overall, one thing you'll kind of see in my presentation is the narrative in the Wall Street Journal and Bloomberg and the FT and so on is, way ahead of the actual cracks on the ground. Although you are starting to see deterioration in credit. Let's start with CMBS delinquency rates. You could see a pretty material increase in overall delinquency rates just from February, kind of before everything went nuts. The overall delinquency was at 3, and now we're up over 4. But still a ways to go towards where things got, back in 2008. You can see a significant spike in office delinquency rate. Mike, move to the next slide. Here's kind of an overall occupancy rate by property type. TREP's a great resource. They've expanded their coverage into bank CRE portfolios as well. They've got a number of banks that provide them with data now. But you can see for the entire 4 major food groups in the CRE space, you're seeing occupancy rates decline across the board. You'll see office there has dropped from the high 80s to the low 80s, while other sectors have stayed relatively stable. Drilling down further into office on the next slide, this is the data from yesterday from Castle, and you can see that the physical occupancy has been stuck at 50% for well over 6 months. Now, we do think there's some momentum for return to office with Meta, other Amazon mandating workers come back to the office. But there's still a very big gap between the physical occupancy of office buildings and the contractual occupancy. And we believe over time, those numbers they won't equal each other, but they'll get a lot closer to what they are right now. If you go to the next slide. Couple points on insurance. Property insurance is skyrocketing, particularly in some of the metropolitan fiscal areas that have done quite well. You could see in places like Miami, New Orleans, Tampa, you're seeing pretty significant increases in the cost of insurance. for assets like hotels, which obviously cut right into NOI. You go to the next slide. The reason why you haven't seen the delinquencies pick up amongst the banks has a lot to do with where interest rates are at. The vast majority of consumer loans are fixed rates. So you think auto loans, think home mortgages. You have so many consumers that are enjoying 2%, 3% rates on their homes as well as their car loans. Fifth Third had an interesting breakdown in their last quarterly earnings report. They showed the differences between their commercial portfolio and their consumer portfolio. And you can see on their commercial portfolio, the entire weighted average life is 1.9 years. And you could see the commercial construction portfolio is 73% variable. Over half of commercial mortgages are variable. 3/4 of C&I loans are variable. Really, the entire commercial book is going to face higher interest rates within 2 years. Either they're facing the higher rates now, or they're going to face it within 2 years. If you go to the last slide, this is precisely why credit has held up. The quarterly bank profile came out a couple weeks ago. NPAs are still at only 41 basis points as a percentage of assets. You know, historical numbers probably look like Q4 2014 would be averages, and they were at 1.2% back then. So, you know, we expect, even if asset quality goes back to normal levels, that is a pretty significant increase in workout assets at all banks. You know, you've seen the stories. Wall Street Journal had a story. Real estate doom loop threatens America's banks, called the CRE market currently in meltdown. You know, we've all seen those stories, but, you know, time will tell who's right, but the narrative is certainly well ahead of what we've seen in delinquencies so far. Having said that, if you look at what Moody's said, Moody's slammed the regional banks for taking less provisions than the largest banks. And I don't think the Alfred E. Newman approach is a good idea. I'm hopeful in the upcoming earnings that you'll see more regional banks taking more provisions and, you know, waking up to the reality that there'll be some higher delinquencies in their portfolios. You know, in our business, office, senior housing, small business loans, small balance CRE, that's where our clients seem to be the most worried. With that, kind of any thoughts on credit, Umrai, Josh, or Jim?
Yeah, John, okay. I think the relationship between rates and credit, and then the backdrop of lower and lower liquidity for the system. The banks are feeling problems in liquidity. Everybody else is, right? That's the transmission mechanism. I think is a relationship that has not been explored or needed to be explored like this in 50 years. So to suggest that, you know, which some of the backward-looking data suggests, not saying anybody here is saying this, that credit won't be a thing, I think is a tough argument to make. That said, it's a little bit scary when you looked at the PPNR numbers driven by margin compression and higher cost of funds. And if the Fed stays here for a while, which was Jim's comment, and you have a non-performing loan and a provisioning cycle on top of that, that's not. It'll be a disappointing environment.
Yeah, I mostly deal with banks that are 10 billion in assets or less. And I think it's good to bear in mind that 90% of the banks in the U.S. are less than $1 billion in assets. I mean, it's so, you know, where most of the small real estate developers in the country get their loans are at smaller banks. And there's been a clear trend this year in pulling back on all but the most quality loans. I mean, I think banks are looking to take care of the best customers, There are some banks in some markets that have just stopped making commercial real estate loans, which is interesting. And those customers are then trying to go to other banks. And I think what they're finding is it's tough. It's a tough move. That banks are more actively managing their balance sheet this year than I have seen them in years. And it's I don't see that changing over the next, at least over the next 24 months. I just don't see it. I don't see it changing. So I think credit, in terms of availability, is a bit of a challenge, and people seem to be paying higher rates. I mean, you see construction loans going on the books at 9%, 10%, and if you need the money, you need the money. So it's an interesting time on the credit side. It's going to be interesting to see what happens with the quality, though, John. I have not yet seen, at least among the banks I work with, I have not yet seen a need to increase the provisions within the banks. I know the regulators are worried about that and such, but I haven't seen it yet.
It's an interesting dynamic because I can't disagree with the trend, right? There's no way that debt service costs and low vacancy can't have a repercussion. That directionally is correct. The part that's harder to assess is, we can't just extrapolate and say, okay, so all of this office property, that was the one category you showed probably most affected, all right? Well, that's all in banks. No, there's CMBS, right? There are public REITs, right? There's a lot that pensions might hold directly that are not in banks, large hedge fund complexes, private equity. So the question is, how much of the pain?
Insurance companies. Don't get the insurance companies.
Massive insurance company side. So how much of that is in the banks? I don't think I've seen a good study of how much of that exposure resides in the banking space. And Jim and Umrai are also both correct. When you get down to the next level of detail, you say, okay, what's the composition, right? Owner-occupied, non-owner-occupied. Owner-occupied is likely not going to have much of an issue. Non-owner-occupied more so. So when you get to the smaller banks, they have a much higher historical percentage of owner-occupied commercial real estate. So directionally, it's easy to say the wind is blowing from the west, but the reality and how it shows its face isn't so obvious. And I think that's what the conundrum we're all trying to figure out is who is without the chair in the musical chair game and will take the hit. Directionally, I don't think it's wrong that the regionals are typically looked at in that direction of where it could happen. But even there, it's really hard to tell. And I think that whoever figures that out will be ahead of the curve on the next credit cycle.
Well, I mean, if everyone goes on a diet, as a couple banks have said, they're going on risk-weighted asset diets and doesn't want to finance CRE, that just makes the problem worse, right? I mean, if financing starts to disappear, then that exasperates everything. So
the buildings aren't going anywhere.
Yeah. Difficult conundrum. Josh, I don't want to pick on you, but you've been vocal about regional banks, and you've argued that they really can't compete on anything but price. How do the regional banks figure out a path forward?
If I knew that, they'd probably put me in as a CEO. No, thank you. I don't know what the answer is to that. It's a persistent challenge. I know it's talked about quite actively at large regulators, OCC and Fed, because there isn't a glaring problem, but there is that underlying issue of how do they define their existence going forward. Now, that said, they've on average survived for decades as is without much problem, and they can probably continue to survive for decades as is without much problem. But along the way, I think it's hard to see how they can outperform either their larger or the much larger competitors or the competitors in a size category just below, who can be more strategic or tactical in finding ways to outperform both in credit and profitability. There's obviously a lot of chatter about whether there should be mergers allowed. All right, we've seen some deals fall apart. We've seen some deals being talked about. So I don't know I don't have a good answer for what they need to do, but I do see that area still as a risk, not of a calamity, but of a persistent underperformance, both from profitability and credit losses.
Umrai, thoughts on the regionals?
Yeah, they're not immune. I say that because obviously I'm echoing Josh's sentiment. The big banks have competitive advantages, and if you look at the amount of consolidation that's happened there, the different business lines they're in, the fact that there's really 5 of them. In the regional space, you might look at the numbers and say, okay, I think it's 350 banks over 10 billion in assets left. Well, that might be too many. It probably is too many. And I think a topic through this cycle that maybe isn't talked about enough, maybe it's talked about in a sort of a different way, the idea of efficiency ratio. We're not great fans of efficiency ratio for reasons I won't go into, but if you don't know why, would love to unpack it with anyone in our audience. But we're bigger fans of net overhead ratio. So I think the net overhead ratio, if you look at the regional banks, those that get their net overhead down to low 1%, industry average is 180. So 1.25% of assets in their non-interest expense net of non-interest income are gonna have to figure out how to get that sort of quote unquote cost advantage. And there's a lot of banks that will have to justify their existence to their, the regulators. I think will be fine with them because they do have a lot of capital. It's different than great financial crisis, but it's really the shareholders that they're going to have to appeal to.
Yeah.
Yeah, I wonder, I look at the regional banks, I think, what's the path, right? What's the path? You have the regulatory body in Washington, D.C. right now, as Josh alluded to, is fairly hostile. I think that's a fair word to use to mergers. And I'm not sure they're particularly enamored with the banking industry as a whole, other than, say the top 10 banks. That's just personal opinion, Jim McAlpin, right? But what should happen is that the 350 banks that Umrai referred to gets down to about 150, right? And that should be happening right now. Obviously, there are economic factors that are getting in the way of that, but I think that's what everybody envisioned, right? I'll have this bank that will merge with another $200 billion bank, and we'll be $250 billion, and our shareholders will all do well. And I think shareholders are being fairly patient right now because what option do they have? But over time, it's going to be interesting to see what develops, because when you start getting into regional banks, you start getting into institutional shareholder bases that are not long-term patient capital. And this is going to be an interesting next 5 years, I think.
Yeah. We have a poll question regarding board engagement. Bankers only again. To the events the past, I meant to say quarter or so. How has the board engagement level changed? Should be the past quarter or so. Bankers only. Significant increase in engagement, modest increase in engagement, no change, or less engagement. Seems like most people are saying boards are getting only 4%, so are seeing less engagement. That seems to make sense. And Jim, I assume that's consistent with what you're seeing.
Yes, bank boards are all about modest, so that's absolutely. We're going to go crazy here. We're going to ask a few more questions, but I think that probably it was. I mean, not probably. Think about when Silicon Valley Bank failed, right? And I'll admit this. I'm on 2 bank boards. I'm in the industry. I had never asked the question during any board meeting, what's the percentage of our deposits that are uninsured? I had never asked that question. Suddenly everybody was asking that question on bank boards. So I think your engagement level at kind of the March to June timeframe was probably an all-time high.
Yeah.
I find the stat, John, encouraging, right? Because it's time to get back to that question about the regionals, but it's really for all banks. And Umrai was touching on it as well, right? With effectively, what is your overhead cost? When you really break down what is the cost structure inside of a bank, right? You've got physical plant, you have human capital, and technology, which is a huge cost, right? So for every account that's open, you're spending something on the order of $3 to $5 per account per month for your core. Times X number of accounts, it becomes a giant number. And that's where that kind of on the higher end of the market, 180 to 230 basis points of cost is, right? Outside of interest, just to operate. So if you want to become more efficient, you want to be more competitive, you have to rethink the way that you're operating that bank to be able to originate your funding and manage your risk in a much more efficient way. And I think that only really comes when boards become more active and challenge convention, because if you just do it the way you did yesterday, it's not going to change.
No. Next poll question has to do with relationships with your regulator, again, bankers only. At your institution, how has your relationship with your regulators changed? Significantly more oversight, moderately more oversight, no change, less oversight. No one said less oversight. Surprising. I mean, Jim, I know you're in touch with a lot of banks on the local level with their examiners. What are you hearing? Are you seeing examiners working with banks? How tough are they being? Maybe you give us some color on that.
Yeah, sure. It depends on the bank, right? I mean, as most things do. I think the banks that are well performing, that have solid net interest margins, that have a good level of capital, are being left alone this year. Clearly, if you're of a reasonable size, let's just say over $2-3 billion, and they see liquidity issues developing, they are all over it this year. They are all over it, and much more, I think, than they would have been a year ago. Because just as I had not asked that question, what percentage of our deposits are uninsured, I don't think the regulators had really thought about that question on the whole before Silicon Valley Bank failed, and now they are. So the banks that are challenged are really challenged with the regulators. The worst thing that can happen to a regulator is to get embarrassed. And Federal Reserve Bank of San Francisco and Federal Reserve Bank in New York and FDIC were embarrassed with those bank failures, and they were called to task. So I'm quite sure they're not going to let that happen again anytime soon, and they're really focused on that issue. But I think for most banks right now, there's been absolutely no change, or maybe a very modest change, because most banks are doing pretty well this year.
Yeah,
from talking to state regulators, less the federal regulators, I would say what Jim said was the reaction, right? Of holy cow, what just happened on the coasts? Is there a time bomb in our backyard? And so I think a lot of state bank commissioners ask their staff to reach out, double down, not to be aggressive. There's nothing negative. Let's just get into these banks a bit deeper. And I think that's what I've seen, especially if you have a business model that's slightly out of the norm. If you're doing anything in the cards space or banking as a service, or God forbid crypto, you definitely have had knocks on the door. So they're just being proactive. I don't think I haven't sensed any agenda that there's a hot button or a memo going around. It seems like some of our regulatory coparts were not aware of some risk. Let's try to find if there's risk that we haven't yet identified. And I think that's the tone I'm seeing, which isn't necessarily inappropriate.
Yeah, I think Josh is right. If you think about most of what the regulators look at, it's backward. It's backward looking. You're getting a call report for the prior 3 months. So what we're seeing now is that banks that appear to be challenged, that the regulators appear to be challenged, they're asking for forward-looking information. They're asking for very current information. What happened last week? Sometimes what happened today? And that really is the change.
Yeah, and that's what's driving. Now, let's face it, we've had a real change in liquidity. So I think for management teams regulators, it's appropriate to revisit all of your, every institution to revisit their current risk position on that key metric, and having a framework, I use that term again, to understand how you compare in terms of liquidity versus a peer group versus your state versus nationally, and having that that prep work done before an exam or to get ahead of it, to where a management team can actually be educating the regulator and educating the examiner, is the type of position that if you can be on your front foot, your ability to execute earnings strategies goes way up. So I guess to maybe wrap that all together, a nice little bow, the proactivity with examiners, it's always been the case, but more important than maybe ever, will impact your ability to earn.
Yeah,
John,
I
love
one real quick thought just on deposits, because I didn't raise it at the time. I've seen a lot of bankers, and even to the CEO level, become very proactive with their major depositors. Let us help you keep a significant portion of your deposits at our bank. Let me tell you about IntraFi. Let me tell you about ways that you can keep the deposits, and I think that's going to continue in the next year. And for those who aren't doing it, I'd suggest you take a look at it.
If anyone has any questions, please send them through the chat function. We probably have time for one or two. The Bank Term Funding Program came out in March this year. Currently, as of August 31st, there's 121 billion under this program. Total collateral pledge in the program is 145 billion. So the banks are getting a pretty strong advance rate. People ask me, well, why don't banks sell their office loans? I said, well, they can pledge them to the Fed for near par. So what do you all think happens when this program gets unwound? I mean, 121 billion doesn't seem like a lot, but we obviously don't know which banks are involved, and obviously there will be banks that have a lot pledged here. How do you see this unwinding, Umrai, Josh?
Yeah, John, I just think if you look at the BTFP terms, conditions, and rate, there's nothing in the private marketplace that can compete against that. So if that needs to be refinanced, it's going to be refinanced with the next best thing, which for most banks is going to be a brokered CD position, a non-collateralized borrowing, doesn't tie up collateral. That's going to cost 5.5%. So effectively, you take that balance, you look at the rate difference between what they're paying on the BTFP and what the next best uncollateralized funding alternative is, and that's the increase in funding cost that's going to hit the system.
I mean, the way I see the program, I don't see that it can go away, right? So just using your numbers, John, if it's 120 billion or so of exposure, and figure based upon what we've looked at in the industry, securities books, duration, and the embedded loss on that, not from credit, right? It's a rate loss for the most part. It's, call it 15, 20, 25 points. So you're talking, call it 30 or 40 billion of embedded capital loss. They're either going to have to keep rolling that, or bank by bank will have to take the loss and move on. But it's not just a funding question. It's amortizing this loss over time while duration catches up. So I just don't see how they can shut the program off without certain banks really in a pinch.
They'll have to use non-collateralized borrowing sources to swap it out, I think, Josh. And then that loss that you're describing doesn't just go away. Not that it doesn't matter anymore. It exists on their books in terms of uneconomic forward income. So it'll be realized economically through time, and it'll show up in the income statement.
Yeah, I mean, one thing I noticed in the last earnings reports, obviously, if we do this a week later, we'll start to see the earnings reports for the third quarter. But I mean, it did seem like, as Moody chided the regional banks, that there was a lot of window dressing going on in the second quarter. A lot of banks were loth to take provisions, boost reserves, take losses potentially by selling portfolios because they're worried about what the analysts would say if they were to take significant losses. Whereas the large banks did an awful lot to increase provisions. I mean, it does seem like banks are having a tough time figuring out what to do. Thoughts on that? I mean, should they be more proactive in being realistic about credit? And should they not be listening to the analysts so much?
I mean, I think Umrai made a comment earlier. I can't remember exactly what we're talking about. We hadn't seen whatever it was for 50 years. You know, if you think about it, I've been in this game for almost 40 years. I've never seen anything like the set of circumstances we currently have. You know, and I think people are being cautious right now as they try to figure it out. I would just make that general comment.
Maybe it's a bad analogy, but even if you haven't ever been on a cruise ship, if you see everybody grabbing a life preserver and you don't, and you're asking somebody, I don't know, how do you feel about not wearing a life preserver? You're going to be a little nervous. So I think when you're not reacting to what seems to be correctly or incorrectly the obvious public view, and you're ignoring that, analysts are going to pound you for it, right? Just because why, what do you have that's so insightful that you think you're fine when I'm seeing what's going on elsewhere? But I think at the top of that, we talked about it in the last webinar, management teams are supposed to be leading and analysts are following, not the other way around. And so trying to run your bank by what the analysts think or will do, that's your mistake. You should be managing your bank as proactively as you can with the best information you can, with your board's advice. And then you share your best analysis and your best view with the community of what you think is going to happen and how you're going to navigate it. They look for confidence. They want management teams that extol confidence. People can be wrong, but if you're just guessing what they want to hear, they know that and they will pound you for it. And that's what's happened.
And you think over the last few years, it's the entrepreneurial bankers who took the headlines, right? It's the niche players, it's the risk takers. I think we're returning more now to your fairly typical conservative bankers. I mean, that are ones who are doing quite well right now, and that may continue for a while.
Those are the ones who have done well over the last 100 years.
Yeah, Josh, there was that study from my alma mater that the high ROE banks had a significantly risk of failure. I mean, surely there is alpha out there, but if a bank is doing too much better than its peers, you should look under the hood a little closer.
That should be a flag for the board. If you're generating a 20 ROE and everybody else is a 12, you have to ask yourself, what am I missing? Maybe nothing, but you should be asking the question.
Yeah.
Hey, John, I have a question for the panel. I know you guys have talked about commercial real estate, managing small business loan portfolios. That's what I'm very interested in. What particular industry should bankers, boards be worried about in their small business lending portfolio? What particular niche?
I just think the difficulty that small businesses are going to have is just what a high percentage of their debt is floating. And if the SBA, you take SBA loans, they're all fully amortizing. So you don't have the option of keeping the monthly payment the same, just less of it goes to principal payment. But I think to me, it's more of a debt issue than anything else. As far as specific industries, certainly, we talked about downtowns. I mean, one of my observations is how all downtowns are suffering to some extent. I was in downtown Austin. Austin's one of the hottest markets, and Facebook never moved into occupying the largest office building in Austin. So you have downtown issues everywhere. So I would say small businesses that are going to be hurt by continued lack of support for downtowns are probably up there. But I think it's more than anything else, it's really a debt issue and a payment issue that I think is going to affect small business borrowers. Anyone else?
No, I would definitely sort descending by levered, counterparties. But beyond that, I think it's easier to say where the issues won't be. It's any necessary business, right? Things that are not industries that are tied to leisure or whim, right? If it's the barber shops, the food stores, the hardware store, life goes on. Like, doesn't much matter what's going on. Those things have to exist. But when you get into things that are more whimsical, that if you do run into consumer confidence issues, that's where it tends to rear its head.
Yeah.
Yeah, I would say look for where the leverage ratios got stretched because asset valuations were stretched. What comes to mind is, probably not hugely on bank balance sheets, but the private equity universe that was, increasing leverage, increasing asset values. So higher leverage against higher asset values. And when that leverage position resets in price or needs to be refinanced, you have a problem.
Yeah.
Leverage loan. Exactly.
We had a comment. Someone is asking for the PowerPoints. They are in the dashboard. You can click on that. If not, shoot an email over to mike@cohnreport.com and we will get those over to you.
They'll also be in the PowerPoint, in the YouTube link as well.
Very good.
Excellent. Once again, this has been a great group of 3 outstanding experts. Bob, why don't you take us away?
Gentlemen, excellent conversation. I always enjoy the panel. And with that, this concludes today's webinar. Thank you very much.
Thank you, everyone.